any money you put into the 401a room will be after tax. I'll make a quick distinction and a quick note here. When a retirement plan says after tax, and when they say Roth, we have to look carefully to see what they mean, because Roth and after tax can mean two different things, okay? In this context, Roth means I put money in that I've already paid taxes on, and my earnings will be tax-free in the future. After tax designation means I put money in that I've already paid taxes on, and if I don't do anything, I'll pay taxes on my earnings unless you move your after-tax contributions to Roth.
You're listening to The Pilot's Portfolio, the show dedicated to guiding professional pilots towards a future of financial success and stability. Fly along with your host, Timothy P. Pope, as he provides financial planning insights and answers to your burning questions, and dives into real-life stories from fellow pilots who share their successes and cautionary tales. The Pilot's Portfolio takes off now.
Well, welcome back to another episode of Pilot's Portfolio. Glad to have you along. This is the show that we discuss all things financial planning for professional pilots, guys. My name is Timothy P. Pope. I'm a certified financial planner and principal at 360 Aviation Advisors, where we specialize in the planning needs of the professional pilots. That means retirement, tax, investments, and then all the financial aspects, the zigs and zags that your financial life is going to go through with goals, challenges, and so forth. So we know the aviation industry, understand the financial life cycle of the professional pilots, the opportunities, the challenges. And so I'm glad to bring this content to you. So if you are new here, welcome to the show. If you're a regular listener, welcome back. And guys, if you haven't done so already, if you could do me a favor, and wherever you listen to podcasts, just go rate the show, write a review if you'd like. That is helpful, and I would appreciate it. Today, we get to do one of my favorite episodes to do, which is a Q&A session, right? So this is where you guys, as listeners, have sent in questions that you want answered. And one of the reasons that I love doing these episodes so much is, number one, it lets me know what you guys are thinking about. But number two, is providing this content. And I know that when I answer a question, right, like that's helpful to somebody. And if it's helpful to one of you, it's probably helpful to a number of you. And I love that. So I love being able to provide the answers there. So if you have questions that you want to get insights on, send in your question, info@pilotsportfolio.com, and we will add it to the next Q&A. So the first question that's up is from Non-Rev Brown. And Non-Rev Brown says, thank you, Pilot Portfolio, for giving us the knowledge to make informed decisions about our future. I have been reading about DAFs, that's donor advised funds, in an attempt to minimize my tax burden. He says, can we as aviation professionals take advantage of the potential benefits of donor advised funds? If I understand correctly, the funds are to be used strictly for charitable purposes. Okay, so you got a couple questions there. One, about how to minimize tax burdens. Can pilots use this? And then also just confirming that the funds have to be used for charitable purposes. So the answer here is yes. As a pilot, you can use a donor advised fund to help minimize your tax burden, okay? And a donor advised fund is like a charitable investment account. And, I talked a good deal about these donor advised funds a few years ago when all the majors were getting new contracts, pilots were getting ratification bonuses, and they ran out of tax-favored places to put the money. And the conversation that we had at the time was for those who were charitably inclined, maybe a donor-advised fund made sense because you could help offset your tax burden in that year and support whatever charitable purposes that you had in mind. Now, usually a donor-advised fund is going to be set up by a 501c3, a charity itself. So, and the way it works is most of your large brokerage houses will have these type of accounts, and they will have a charitable arm. So if you think about a Fidelity, you think about a Vanguard or a Schwab, all of those custodians usually will have a charitable arm that will set up the donor advised fund and the account. And then you, the pilot, are the donor. Okay. And so technically, when you make a charitable contribution, you do not own those funds anymore. Now, where the donor advise comes from is since you're the donor, you move cash or investments in this account. When you do it, that's going to be considered a charitable contribution. So technically, you do not own the funds anymore. However, as the donor, you will make recommendations to the fund of which charities you want to support. And of course, the charity, the donor advised fund, the 501c3 that supports that account will listen to you and make those contributions. So if you move cash into it, it's pretty easy. If you move investments like stock that you have a pretty high gain on, you can transfer the stock from your brokerage account into the donor advised fund without selling the stock, without realizing any capital gains. And the nice thing here is, let's say that you purchase a stock for $100 and now it's worth $1,000. Well, your capital contribution was only that $100 purchase price. But when you move that $1,000 stock to the donor advised fund, you're going to get the tax deduction on the higher amount. You're going to get a tax deduction on the $1,000. So that's pretty cool. So let's continue talking about how this impacts your taxes. That's what non-Rev Brown wanted to know. There are a couple changes to the tax law in 2026 that you want to be aware of when making donations to qualified charities. And typically when I say qualified charities, I'm talking about public charities that fall under the 501c3 designation. Okay. Here's the first change. If you do not itemize your tax return, so you take a standard deduction, starting in 2026, you are allowed up to a $2,000 deduction for cash contributions to a qualified charity if you file married, filing jointly. And you're allowed a $1,000 deduction for cash contributions if you file your taxes as single. It does have to be cash. It can't be like goods or, things like that. You think about a Goodwill or so on. Hey, we give $2,000 worth of items. It can't be that. It needs to be cash. And then also a donor advised fund contribution will not qualify for the $1,000 or $2,000 deductions. Okay, so just be aware of that. And that's if you take the standard deduction and you do not itemize. Now, if you do itemize, this is a change in 2026, your charitable contribution will need to exceed 0.5% of your AGI before you're allowed to start taking a deduction there. So let's just put some numbers to this. If your AGI is $400,000, the first $2,000, if you itemize, will not be deductible, but then the remaining contribution will be. So as a refresher, a tax deduction just means that, hey, I'm taking moves to lower my taxable income. So again, if my AGI is $400,000 for the year and my taxable income is also $400,000, and I make a $40,000 contribution because I have to overcome that 0.5%, which is $2,000, this contribution will lower my taxable income to $362,000 instead of the full 40, which would be $360,000. So just keep those changes in mind as you think about your charitable contribution. Now, let's talk about this question here. Why would you want to use a donor advised fund instead of giving money directly to the charity of your choice? And that's a great question. I mean, there could be several reasons why you may want to use the DAF. Now, I will say, if you already know the charity that you want to support and you have the cash available, it's not in appreciated securities or stock or anything like that, and you're ready to contribute all the cash all at once, then hey, contributing the cash may be the way to go. All right. However, if you are unsure of what charity you want to support, but you'd like to take the tax deduction this year, that's where you could put the money into a donor advised fund and you could wait to figure out which charity you'd like to support. Or, I've already talked about this a little bit, what if you're giving appreciated like stocks or mutual funds, or marketable securities? What if you want to give that because you have a really high gain on it? You want to give that to a charity. Well, sometimes some charities aren't set up to receive, funds like that. Maybe they're set up to receive cash, but they're not really set up to receive stock. Okay, no problem. We transfer those appreciated securities to the donor advised fund without triggering any long-term capital gains or net investment income tax on your tax return. Once the funds are in the donor advised fund, then you can sell the securities and you can give the charity cash. Also, sometimes you may want to spread your gift out over time. maybe you want to donate $200,000 into the donor advised fund this year, but maybe you'd like to do $10,000 gifts to a specific charity each year over a period of time here. So what you can do is you can make that contribution, your $100,000 or your $200,000 to the donor advised fund this year. You could take the tax deduction this year as long as you itemize. And then from there, you can actually invest the money inside the donor advised fund. You could create a portfolio that would support growth over time. And then you can automate your giving, right? To that $10,000 a year or whatever it is. So a donor advised fund in that case can satisfy that strategy. So there are some use cases for it, and then there's some changes to be aware of in the tax code starting this year in 2026. So Non-Rev Brown, I hope this helps, and thank you for your question about donor advised funds. Thanks for making a charitable impact there and doing it in a tax-savvy way. All right, let's take a quick break. If you are a high W-2 income earner and you're earning more than $350,000 a year, over your lifetime, taxes are likely a very large expense. At 360 Aviation Advisors, we take a tax-aware approach to building wealth, so more of what you earn stays working for your family. You can learn more at 360aviationadvisors.com, spelled 360aviationadvisors.com, and the link is also in the show notes. Now let's get back to the show. The next question that we have is from Kevin from Southwest. He says, hey, I'm a Southwest captain and I just listened to the podcast on taking NEC as Roth. My question is, now that I'm taking NEC as Roth, in parentheses, not 100% sure I should be, will it affect my ability to contribute/convert to my private Roth IRA? All right, Kevin, great question here. I figured we'd have some questions on the Southwest NEC as Roth conversation. The answer is no. So taking your Southwest NEC as Roth does not prevent you from contributing or converting to your individual Roth IRA. Now, as a captain at Southwest, I'm going to presume that you are not making direct contributions to your Roth IRA, but rather you're making contributions via the backdoor Roth conversions that you may be familiar with, okay? So as long as you're making those backdoor Roth conversions correctly, meaning you don't have any pre-tax IRAs out there that you run into the pro rata rule about or with, then you're probably in good shape, okay? But let's say that you do have pre-tax IRAs and that you are converting those to Roth. Now, this is going to be a taxable event, but still, choosing to take your Southwest NEC as Roth will not impact your ability to continue those conversions. And I think all this kind of leads up to the next level question, which you hinted at when you said, hey, I'm not 100% sure if I should be taking the NEC as Roth, and that's tax strategy, right? And I'm not 100% sure that you should be either, not because what you've described sounds wrong. There's just far too many details about your circumstance and your goals that I'm not aware of that we need to know to be able to answer that question. Hey, should you be taking NEC as Roth? So it sounds like you're planting seeds for a tax-free growth across your Roth IRAs. Kevin, love that. And thank you for the question. Kevin didn't ask this question, but I want to piggyback on another question that I was asked here recently about taking the NEC at Southwest as Roth. Guys, if you are doing your own Roth IRA contributions in your 401k and you're leaving the Southwest NEC as pre-tax, then there is no need to either set money aside or pay estimated taxes or anything like that. You can continue doing what you've always done. It's when you take the NEC as Roth, just be aware Southwest is not withholding any FICA tax on that, nor are they withholding any income tax on it as well. So I wanted to throw that in, piggyback on the Southwest question. All right, we've got another question here. We've got one more. And let's see. This question is from an anonymous listener at Delta. They say, hey, at Delta, we have a 401k and 401a, and before tax and after tax contributions, and a Roth 401k. They say, I understand the 401k and Roth 401k, but the 401a confuses me. I was told to properly take advantage of the full contributions, you need to contribute to the different plans, 401a and 401k, in the correct order as to not hit the contribution limits at the wrong time. All of this is confusing to me. They continue and they say, right now, I do not contribute to my 401k plan at Delta. I just take the company contributions and convert them all from 401k to Roth 401k before the end of the year and take the tax hit now. I have been wanting to understand contributions better because my plan is to make more advantage or take more advantage of the before tax contributions when it makes sense with my income. All right, so there's a lot going on about the retirement plan at Delta, particularly between the 401k, the 401a, the pre-tax contributions, the Roth contributions, and the after-tax.
Hey, pilot, are you looking to save 20% on the sale or purchase of your next home? Let me tell you about a friend of the show, Beacon Relocation. With Beacon's exclusive real estate benefit, you can save thousands. My family has actually used their services when we needed to sell a property that was multiple states away. Beacon has over 1,500 experienced agents providing outstanding service and expertise as they guide you through every step of the buying or selling process. They'll even connect you with a national lender who offers competitive rates and discounted programs. As a Pilot's Portfolio listener, you are eligible to receive 20% of the real estate agent's commission towards your closing cost on the sale or purchase of your home. Visit beaconrelocation.com today. Select Pilot's Portfolio via the Apply Now drop-down menu to activate your benefits and make your next move your best move.
Buyer credit varies in some states. Contact us for details.
Let's talk about this question about how to fill up 401k retirement saving buckets at Delta. There is several layers here. So let's start with the big picture, okay? The defined contribution plan at Delta, that's what everyone commonly refers to as the 401k. That's the retirement plan that you have the most control over. This is the plan that you, the pilot, can put money into, and the company's NEC also goes into first. Maybe let's use an analogy, right? I want to think about this account like a house with a few different rooms. So this house can fit $72,000 in it if you're under the age of 50 this year. The first room that you dump money into is your 401k. And this year, the maximum is $24,500, again, if you're under the age of 50. And the neat part about the 401k room is you can choose whether you want to fill it up with pre-tax dollars or Roth dollars. So I get to determine, do I want to make contributions in a way that lowers my taxable income today? And if I do, I'm going to choose to fill up my 401k room with pre-tax dollars. If I decide it makes sense for me to pay taxes now and to not pay any taxes on my earnings in the future, then I'm going to choose to fill up my 401k room with Roth dollars. Now, let's cross the hall, and the room that we find across the hall is going to be the 401a room. Now, remember, in 2026, if you are under the age of 50, the total contribution amount for your plan is $72,000. So if we've already tucked away $24,500 in the 401k room, and we cross the hall and step into the 401a room, there's only space enough for an additional $47,500 in this room. And here's the kicker. The company NEC gets dumped in here. All right. So that first paycheck that you get in January, your 18% is getting dumped into this 401a room. And you also have the ability to put money in here. When you go to Fidelity's net benefits, change contributions, you'll see a 401a option that will allow you to direct money here. Now, any money you put into the 401a room will be after tax. I'll make a quick distinction and a quick note here. And I have totally been guilty of doing the same thing. So when a retirement plan says after tax, and when they say Roth, we have to look carefully to see what they mean, because Roth and after tax can mean two different things, okay? So in this context, Roth means I put money in that I've already paid taxes on, and my earnings will be tax-free in the future. Well, as long as I meet a couple of rules. But the earnings will be tax-free. There's nothing I need to do about it. It's in Roth, okay? After tax designation means I put money in that I've already paid taxes on, and if I don't do anything, I'll pay taxes on my earnings unless you move your after-tax contributions to Roth. And when I said earlier I've been guilty of it, because I've used Roth and after-tax interchangeably, and in a lot of cases that can make sense, except when your retirement plan has a Roth designation and an after-tax designation. There, we need to know the distinction that, hey, for those after-tax dollars, I'm going to need to move them over to the Roth designation. Otherwise, I'll end up paying taxes on my earnings. So if you've ever heard me talk about a mega backdoor Roth conversion, this is what I'm talking about. And the only thing that makes it mega is that when you compare it to a regular backdoor Roth conversion, like we were just talking about with Kevin just a moment ago, it's just much bigger. You can just put way more money in this 401A and move it over to Roth than you can with a regular Roth IRA. So back to the listeners' questions here. They said they've heard that you have to contribute in the correct order so as not to hit the contribution limits at the wrong time. So I'm not 100% clear on exactly what the listener heard or is referring to when they say that, but I'll share what I think they're likely referring to. So you'll recall that Delta is giving you 18% NEC this year. And if you fill up your 401k with $24,500, and if you're under the age of 50 and your maximum is $72,000, that means that the 18% NEC will begin generating spill cash for you on your first $263,889. So this means that you will hit that $72,000 mark if you're earning $263,889 or above. And if you've elected the market-based cash balance plan, you'll begin to receive money there, which is all pre-tax. Remember, you don't control how that's invested, and it's invested, more conservatively, a 40% stock, 60% bond target. So when I hear, make sure you don't hit the contribution limits at the wrong time, this sounds like it's coming from a captain who's definitely making more than $263,888 for the year or $889 for the year, who is interested in maxing out the amount of Roth dollars in their plan before they reach the spill cash limit. And then everything begins going the market-based cash balance plan. So the way to do this is you'll want to be fairly aggressive with your contributions early in the year to both the 401k side of the house and the 401a side of the house. You fill them up with as much money as you can, as fast as you can, to try to race the company's NEC from filling up with more pre-tax dollars than what you want. And then when you do this, just remember to make sure that the 401a contributions are moved over to Roth, so your earnings will also be tax-free. So I hope this helps. Anonymous from Delta, thank you for sending in this question. And, I'll remind all of our listeners as we talk about different strategies on this show, remember that all of these strategies are tools in your toolbox, and you'll move in and out of seasons in your financial life where using one particular strategy makes more sense than using another. So when you listen to the content, it's probably helpful to avoid the temptation of saying, okay, man, I got to do it all. Got to do all of it. Rather, focus on, what strategy should I be using right now to advance my financial well-being and to secure my current and long-term goals, right? And also just note that is probably going to be different than the next guys. So guys, I appreciate you tuning into the show. Appreciate all the listeners. I love your questions. Okay. So if you're a listener, you got questions, you haven't asked them yet, info@pilotsportfolio.com. Send it to me. Would love to put that on the next Q&A episode out there. Also, big shout out to our sponsors, Beacon Relocation, for supporting the show, helping you guys save money on your next real estate transaction, whether it's locally or across the country. Thank you to Beacon for your support, and to the pilot out there at home that has noticed that, hey, you found financial success. All of a sudden, it seems that you don't have enough time in the day to do everything on your plate. Maybe you have lingering questions about your financial future, or the stakes have changed. If you're ready to take the relationship to the next level, to partner with an advisor who knows your industry, schedule an appointment. Let's talk. That link will be in the show notes. So guys, that's going to do it for today's episode, and we'll see you on the next one.
Thank you for joining this episode of Pilot's Portfolio. If you found this information helpful, spread the word and share it with a pilot buddy. Or if you have questions and there's something that you would like to hear discussed on the show, send us an email. You can find the address in the show notes. For those of you who are ready to learn how we help professional pilots with their financial planning needs, schedule an appointment. Until next time, keep the shiny side up, and we'll see you on the next episode.
Pilot's Portfolio is hosted by Timothy P. Pope. Timothy P. Pope is principal owner of 360 Aviation Advisors, 360 Aviation Advisors is a registered investment advisory firm regulated by the state of North Carolina in accordance and compliance to the securities laws and regulations. 360 Aviation Advisors does not render or offer to render personalized investment or tax advice through Pilot's portfolio. The information provided is for informational purposes only and may not be suitable for all investors and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.